Hundreds of thousands of policies canceled.
Insurance here in the state of California is dysfunctional.
People paying more for less.
I'm completely not covered for any kind of fire that happens.
People can't afford to have the most valuable thing they own.
With no simple fix.
California was once the land of dreams, between the perfect weather, booming opportunity, and a promise of the good life for families. But for many families, that dream has now turned into a nightmare.
If you live in California and you are worried about, the skyrocketing rents, prices of homes, inflation, gas that still hits $7 a gallon, they don't want to insure homes or watches and they don't want cars. They don't want to insure anything. Tons of people are pulling out.
I can't live in California anymore. I'm a social worker, a single mom of 3. I have a master's degree. I just got a decent job, but I can't support my family here.
So we're reaching out because we know there are other people out there that are just like us, that you're drowning in debt and you're killing yourselves to make ends meet. 2 months ago, we decided to get out of California hell because it's just getting worse and worse and worse here.
It's not getting any better.
It sucks.
Got a question for you. Let's just say you are CEO of a homeowners insurance company. You're using your family's money. You're living in the state of California. Every single policy that's being written is losing money for you. 7% of all real estate deals in the state fell out of escrow. Do you know why? Because the buyers couldn't afford the insurance. They're like, I just can't afford to pay the homeowners insurance here. Makes no sense. I'm out. I'm not buying it. 7 insurance companies in the state of California, State Farm, Allstate Farmers, USAA, Travelers Nationwide, and Chubb recently limited new homeowners policy.
People in California are dealing with a fresh crisis at home. Premiums have jumped over 32% since 2021, while in certain wildfire-prone areas, companies have pulled out entirely. Close to 400,000 homes now depend on the FAIR plan, the backup option built for far fewer customers.
You started to see massive FAIR plan growth. And you don't want massive FAIR plan growth. You're going to pay more and you're going to get less. If the FAIR plan runs out of money, there's no state bailout.
Folks who used to plan for $3,000 yearly now get renewal notices topping $6,000. This week, Governor Gavin Newsom finally spoke up, calling the state's insurance setup unable to last. To millions of regular homeowners, that feels like saying a storm is just rain. To get why things blew up now, go back 3 years. From 2020 to 2022, California's housing surge seemed endless. Super low home loan rates hovering around 3%, mixed with people relocating during lockdowns, plus shifting to online jobs. Households moved out of packed seaside cities into places like the Inland Empire, Sacramento, or hillside zones. These spots gave room and lower prices, yet hidden dangers they hadn't expected. By late 2022, home prices averaged over $890,000, up more than 30% since before the pandemic. Supply dropped under 2 months' worth. Buyers snapped houses up fast, often in heated bidding battles. Builders couldn't keep pace. The boom that boosted homeowner wealth also piled huge gains into wildfire zones, where insurance payouts were already sky-high. Once rates jumped in 2023 and demand cooled, the high price tags remained. Costly properties, worn-out systems, plus rising risks insurers couldn't afford anymore.
Why did insurance companies pull out of California right before the wildfires? Well, in the 1980s, California passed a bunch of regulations on insurance companies. They included things like requiring the state to approve rate increases, prohibiting companies from passing certain costs on to customers.
Back then, demand shifted in big ways. About every 4th house sold without a loan during 2022, breaking past records. Instead of families, big investors like hedge funds bought whole neighborhoods near Riverside and Sacramento. Folks from Texas or Florida snapped up coastal properties for vacation rentals. Even though paychecks only grew by 9% between 2019 and 2024, home costs shot up well over 30%. That gap left regular working families stepping into homeownership with almost no cushion at all, while investors bought up properties, messing up the balance of risk. Big companies might cover themselves for a while, yet newcomers stuck with loans didn't have that luxury. Banks insist on active insurance. No policy means no sale, and no loan updates either.
And many homeowners have had to turn to the California FAIR Plan, the bare-bones, high-cost fire insurance of last resort.
California is at an insurance crossroad.
Come mid-2024, whole blocks shifted from hotspots for flippers to zones where coverage vanished. The insurance crisis kicked off in May 2023, when State Farm said it wouldn't take new home insurance customers in California. Soon after, Allstate did the same. Not long after that, Farmers, AIG, along with a few regional companies, started pulling back too. By mid-2024, 7 out of the 10 biggest insurers either halted new policies or tightened their rules. In areas prone to wildfires, rates jumped 40 to 60% in just 12 months. Some quieter neighborhoods got hit hard too, thanks to rising global reinsurance prices. The FAIR Plan, which covered around 200,000 households pre-pandemic, is close to hitting 500,000 now. Areas near the coast, like Ventura or Santa Barbara, even chunks of Orange County that used to feel secure, are losing coverage. Risk models now tag them as high-danger spots because of dry conditions and wind. Homeowners who've never made a claim are suddenly told their policy's ending, all because a satellite photo shows brush nearby. For these folks, it's not abstract. It hits when they read a notice saying no insurer will touch their house, no matter the cost. Once you add up today's expenses, the numbers hit hard. Back in 2020, an average house in California with a 3% loan ran about $3,200 each month once taxes and insurance were factored in. By 2025, that identical home under a 6.7% rate jumps to more than $5,100. This doesn't even include HOA fees or special charges. That's a 60% rise in monthly payments for the exact same space. Property taxes pile on about 2% yearly, while insurance runs 5 to 10. The California Association of Realtors says just 15% of homes fit what most families can afford. The worst access anywhere in the US. Debt compared to income usually sits around 45%, way above normal lending limits. HOA charges in wildfire areas hit roughly $200 per month, paying for vegetation removal and private hydrants, since public services have pulled back. Young buyers aren't just stunned by price, they're hit by money flow issues, making home ownership feel like a high-end perk.
Much of it has to do with so-called reinsurance. That's the insurance companies buy to cover claims when major wildfires and other disasters cause them to skyrocket.
The market's response has been just as intense. Houses are staying listed around 61 days now, 10 more than a year ago. With deals falling through, pending sales have dipped close to 25% across the state. Agents keep seeing transactions fall apart during escrow, especially once insurance numbers come in. Up in Sacramento, a broker said about half his June agreements fell apart when rates jumped threefold between offer and close. In Sonoma County, folks planning to spend $2,000 yearly on insurance got quotes closer to 7 large. Sellers are being pushed to toss in credits or short-term coverage just so deals don't fall apart. Over 4 out of 10 listings now show lower prices, the most since things tanked at the start of the pandemic. Cash isn't drying up due to lack of interest. It's fading because protection dropped out. No coverage means banks can't finance homes, and when loans freeze, the whole housing scene grinds to a halt. The real chill hit in August 2025, after lightning storms sparked several wildfires throughout Northern California. Within 48 hours, flames tore through 60,000 acres, pushing people to flee from Shasta, Placer, and Yuba counties. Right then, insurance firms hit pause on canceling or issuing policies statewide. A short-term move aimed at shielding current clients. But really, that froze everything dead. Escrow staff wouldn't sign off without insurance proof. Lenders froze hundreds of deals at once. Appraisers stalled on finishing their paperwork. In certain areas, house sales just vanished for 7 full days straight. In under 2 days, numbers turned into reality. Households started loading up moving trucks while contracts fell apart. Brokers called it the housing market freezing mid-step. Once flames were out, loan teams still needed weeks before resuming work. Trust, already shaky, plummeted even further. Governor Newsom's September 25th news event admitted how bad things have gotten. Instead of waiting forever, his team wants to speed up how fast the Department of Insurance okays rate changes, helping companies charge fairer prices while sticking around. Coverage caps under the FAIR Plan will jump from $3 million to $5 million, aimed at pricier houses. Meanwhile, a shared reinsurance pot run by the state kicks in when disaster hits hard. Plus, officials must now look into mapping risk by region so insurers feel safer returning to neighborhoods with lower or medium risk. Newsom called it an update, not a rescue. When the setup doesn't shift with climate changes, homeowners take the hit. Local leaders say there's barely any time left. Each month rules stall. Hundreds of sales freeze and tax income drops by millions. Banks are pushing for a short-term state promise to back new mortgages in danger zones, though no decision's been made yet. Beyond political talk, the real problem is getting stuff done. How to keep things running while changes inch through red tape. Down on the street, things look totally different depending on where you are. In LA County, typical house prices sit near $1.05 million. That's 7% higher than last year. Even though sales have dropped by 18%. Home insurance runs about $3,400, which is a full 25% jump from last year's cost. Over in San Francisco, condo listings are piling up. There's now 32% more supply, while homes sit unsold for an average of 70 days before moving. Sacramento plus Redding are seeing the sharpest jumps in costs, up 40 to 60%, while San Diego stays flat because of newer roofs, stucco walls, along with rules that clear brush near homes, cutting fire risk. Fresno's home prices rose 15% this year as buyers stepped back. Over in the Inland Empire, insurers are pulling back faster than prices can keep up, leaving owners stuck. They want to sell but can't find buyers who qualify for coverage. Every city shows a similar pattern. Too much danger piles up. Affordability cracks, then trust fades bit by bit. Beyond the noise, real people are struggling. Take folks in Chico who lived there forever. Homes long paid off. Now their insurance costs more than taxes on the house. Over in Riverside, young couples sign papers on brand new places but find out too late that the builder's coverage vanishes after a year, forcing them into pricey private plans. Meanwhile, landlords across San Bernardino pass down ballooning premium hikes to renters, tacking another 6% onto already tight budgets. Each number stands for families wondering if life in California still makes sense. 3 years running, more folks have been heading out than moving in. About $400,000 each year, thanks partly to how shaky insurance has gotten behind the scenes. What happens next? The housing scene in California depends on credit, insurers, plus trust among buyers. Trouble is, each piece is under pressure today. When coverage stays pricey, property prices stall. No matter how low loan rates drop. Freddie Mac sees 30-year rates possibly dropping under 6% by mid-2026. Yet the Insurance Information Institute warns home insurance could rise another 15% across California. The California Association of Realtors predicts a small 2% bump in sales next year, if new policies actually hold up and fire seasons don't go off the charts. Contractors aren't rushing in. New construction is still expected to run about 10% below pre-pandemic numbers because reinsurance is shaky and building materials cost more. On top of that, rents have climbed 6% compared to last year, soaking up demand from buyers who've given up on purchasing. Homeowners just need a few things sorted. Start by grabbing several insurance estimates right away. Do it before putting down any offer at all. Next, check if your place falls within a high fire risk area or near flood-prone lines. Then plan cash flow smart. When the lender says 3 bills monthly, go ahead and count on twice that. For sellers, setting fair prices while giving coverage credits might be what keeps a deal alive or kills it. Yet for policymakers, moving ahead means teamwork. State regulators teaming up with county assessors and private insurers to swap data rather than stay cut off from each other. Governor Newsom says things will get better, which might soothe investors for now. Yet folks paying mortgages care less about rallies. What matters is the letter showing up in their mailbox. The state's insurance mess isn't some staged drama. It's more like steady ground giving way beneath regular families. Even if new rules pass or flop, one thing stays clear. If people can't count on protection for their homes, property sales dry up. And when that happens, the growth machine behind California's prosperity could sputter out for good.